The Reserve Bank of Australia and the Bank of Canada both have important rate decisions on Tuesday. The Bank of Canada is expected to hold on the brakes for now, but will the RBA hold fire to allow the economy to absorb last month's 50 basis point cut, or will they decide a bit more stimulus is needed at present? Joining me now on the phone to discuss both central banks ahead of this week's rate decisions is Greg Anderson, Head of FX Strategy for North America at Citi. Greg, there's talk of a 25 to 50 basis point rate cut by the RBA in the face of uncertainty over Europe and China, as well as weakness in Australia's non-mining sectors. What's your take on tomorrow's interest rate decision by the Reserve Bank of Australia?
I believe that with the 50 basis point rate cut that was done at the last meeting, the RBA had intention to hold this time around, and still think that there's pretty high possibility that they do that. However, I will admit that the market uncertainty of the last several days, culminating with the U.S. payrolls report and the weak global PMI round on Friday, probably raises the odds of a rate cut somewhat. But I still wouldn't put it past 50% odds of a 25 basis point rate cut, and I don't believe that they would do 50 this time.
What about your predictions for the cash rate by year's end? And at this stage, what do you think is currently penciled in by the financial markets?
Our economists have just another 25 basis points of rate cuts in their expectations. I believe that that's probably reasonable, 25 to 50 basis points. Of course, the market has more like 100 basis points priced in of additional easing.
The Australian dollar is near multi-month lows, dropping by 5% against the US dollar over the past month alone. In the coming months, is the Aussie dollar looking even more vulnerable to the downside alongside this heightened degree of risk aversion in markets?
I don't think it's more vulnerable, and probably less. The key thing to point out there is the positioning of the market. That early part of the year, and when we were between 105 and 110, market participants, FX investors, were extremely long of the Australian dollar. And on the move down to parity, they kind of squared up. And the move from parity and below to our lows last week of, call it 96, the data shows that the market is now substantially short of the Australian dollar. And if the market has already gone from really long to short, there's sort of a lot less room for it to fall at this juncture.
Moving on to discuss the Bank of Canada, the market consensus is for rates to be kept on hold, but the tone from Central Bank Governor Mark Carney should be quite interesting. Expectations for a hike as early as fall are still quite substantial, but do you think his semi-hawkish rhetoric could begin to slowly shift?
It'd probably be toned down just a little bit, and what the Bank of Canada, I believe, was trying to do, in recognition that sort of have too low of a base rate and maybe a bit behind the curve in rate hikes, attempted to just talk the market into a tightening bias at the last go-around. And I believe that was acting under the anticipation that the Fed would end Operation Twist. Since doing that, sort of the whole global outlook has shifted. And I think from Carney's position, he probably would want to soften his rhetoric just a little bit, but it's admittedly a little bit embarrassing to put that signal out there and then, the next meeting have to take it back. So I don't think it'll be completely taken back.
How would you characterize the current state of the Canadian economy right now?
Much closer to full employment and operating at capacity than either the U.S. or Europe, but with risks that stem from proximity to the U.S. and what would happen if the fiscal cliff problem in the U.S. and so forth transmits through to Canada. The second risk and issue is the strong Canadian dollar, something that continually gets brought up by the Bank of Canada in their statements, that even sort of where we're at now, they feel like their manufacturing sector is not competitive.
Given the fact investors are shunning riskier assets and weaker commodity prices, what is your outlook for Loony dollar for the remaining quarters of this year?
We thought that we would get up to about 104, and we're there. And I do think that in a market that is full of turmoil and seeking safety, we understand that the yen and the U.S. dollar may be 1A and 1B in terms of safety currencies, but Canadian dollar is 1C. because of the outstanding fundamentals and relatively low volatility against the dollar. And I don't think it's going to depreciate much further from here.
Greg, thank you very much for sharing your opinion on the matter. A pleasure, as always, speaking to you. I'm afraid that's all we have time for at the moment, but do stay tuned to Duca's Copy TV. Till next time, goodbye.